Hello and welcome to PolicyBazaar. I'm Arjun Bhagat. Now, mutual funds and unit-linked insurance plans, or ULIPs, are two of the most popular investment options available for investors today. Both offer investors an exposure to a market-linked portfolio, giving an opportunity to earn positive returns. Now, these two products are clearly different, yet fairly similar in their functioning and structure, which can result in some confusion when it comes to financial planning. So what sets these products apart and brings them together, and how does an investor decide on the best investment tool? Now, to give us more clarity on the subject, we have with us Yashish Dhaya, CEO and founder of PolicyBazaar. Yashish, tell me, what is a ULIP and the investments in mutual funds? I mean, give us some clarity on both these products which are available.
See, both mutual funds and ULIPs are essentially an investment into mostly the stock market, although technically they can also be in fixed deposits or government securities, so you can get fixed income from both of them. But essentially, a mutual fund is an investment in a particular kind of fund, mostly related to the stock market. And ULIPs are also based on pretty much the same fundamental principles. They are also largely based on the same investment pattern as a mutual fund. So a mutual fund is part of is basically the underlying part of a ULIP is the same as a mutual fund. However, ULIPs have certain other features which also come in, which are linked to insurance and certain other categories. So they're a safer type of investment with some lock-ins. However, fundamentally they're the same. And usually they mean investing alongside the stock market, which usually is the highest long-term return product that any economy has.
So let's go systematically. You talked about the similarity. You said they are both products which are very, very similar.
Yes.
So let's talk about the similarities before we get into the differences.
So the similarities are, if the stock market goes up and you have a mutual fund which is linked to the stock market, the mutual fund has a NAV which also goes up just like the stock market goes up. And similarly, the ULIPs also have an NAV, which if the stock market goes up, they also go up just like the stock market goes up. If you have the same products which are linked to fixed deposits or fixed return products, you will get fixed returns for that period. So essentially, both of them have got units in them which grow basis the underlying asset which you have invested in, which is usually the stock market. That is a similarity. Both of them are usually long-term investments. So you typically would not want to invest in them for less than a 10-year period because it will not give you safe
kind
returns.
Of returns that you talk about.
Safe returns. See, returns you may still get. In fact, short term maybe when you can get the highest returns. However, they'll be risky. In the short term, there's a lot of fluctuation in both of them, specifically if you invest along the side of the market. But in the long run, they are both capable of giving you very high returns. As I said, they by definition have to pretty much give you the highest possible returns in any economy.
Right.
The highest return in any economy has to come from the stock markets, primarily because if anything can give you a high return than the stock market, it will become part of the stock market.
Right.
So if DLF makes more money than the stock market, it will get listed on the stock market. So similarly, most profitable companies do go and get listed on the stock market. So essentially, stock market by definition has to give you the highest returns possible in any market over a long period of time.
So what about the differences now? Because again, that distinction is pretty important.
Okay. So a mutual fund is fairly straightforward. You invest in the units, you exit at any point, it is totally liquid, you can invest anytime and you can exit anytime. Of course, there are some tax implications which you may not get all the benefits if you exit very quickly. But they are, on the whole, a very flexible instrument where you can come in and exit at any time. There is a fund management charge that goes into a mutual fund, which is typically about between 1.5% to 2.5%, which you pay every year on the funds under management. Now, the ULIPs are essentially a mutual fund with certain other benefits. So from day one, in case something unfortunate happens to an individual, they would still get the total, what they call sum assured from day one. So they've got a risk benefit. Now, but there's some charges that come with that risk benefit. Usually, there will be something called a premium allocation charge, which would be invested in upfront, and there'll be some other charges that will come in. They also have a lock-in. A ULIP will typically have at least a 5-year lock-in. And usually, we would advise people to stay in it for a 20-year period because ULIPs, unlike mutual funds, have got loyalty benefits which start coming in after about 10 years. So most companies will have a loyalty addition, which is essentially their way of returning the charges that they have made back to the... Because
so in some sort of a bonus or
it's some kind of a bonus. So essentially, it's a longer term investment. It's a fixed term investment. ULIPs should usually be entered into when you have a goal in mind. So you have a goal of a pension, or you have a goal of a child growing up and needing some money, or you have a goal to in 10 years' time investing in a particular property, that is when ULIPs come in. And because they are a very safe and secure instrument, which gives you that in a guaranteed manner, that goal gets protected upfront.
And with that added benefit of an insurance cover.
With the added benefit of an insurance cover from the word go, they have all kinds of benefits in case something unfortunate happens. Then not just is the insurance policy intact, one never has to pay for that policy any further. So there are lots of advantages that come with it. However, there is a lock-in period of 5 years. And usually one would not advise anybody to get into a ULIP if they did not have a time frame which was at least 10 years.
So, we've been talking about the differences of ULIPs and mutual funds. All right, so, which investor, I mean, you talked about parents investing for their kids, so ULIPs would, can you elaborate on that? What would benefit which kind of investor there?
Sure. So, basically, they are for the same kind of investor, but if you are investing only for returns on your money, and there isn't a particular goal for it except for making money for money's sake, then the mutual fund is perhaps the best instrument, although there are some ULIPs which are now cheaper in total cost of operation than mutual funds, and we can touch upon those.
And you had mentioned some time back, you had talked about the fact that ULIPs have become much better products in the last couple of years.
ULIPs used to be a very expensive product for the consumer till about September 2010. After that, they became much better products for the consumer. However, the distribution margin on ULIPs came down dramatically, and so there's almost nobody selling ULIPs. And because insurance tends to be mostly a sold category, one has stopped hearing about them a lot. So one has to almost go out and look for the low-cost ULIPs. But there are low-cost ULIPs. See, a mutual fund, as I said, operates at about a 2% price band in terms of total fund management. So if you're investing 1 lakh rupees a year, and it's accumulated to 20 lakhs now, on any particular year, there's a possibility that 2% is going to be deducted, which is roughly going to be about 40,000 rupees, which is a lot of money. So typically, now there are ULIPs which can operate at as low as 1.09% total cost of operation. The reason that happens is because they pay back in terms of loyalty benefits in the end. So you have to stay the ULIP course throughout the period, and then there will be a possibility of beating mutual funds. However, you asked which kind of individual should invest in a ULIP. Usually, you should invest in a ULIP when you have an objective, which is, so you already know what you need that cash for. Whether it is your own retirement planning, whether it is a child growing up and needing that money for education or marriage or settlement of some sort, whether it is buying a property, whether it is just something that you need to have, like something like, for family protection, you need to have maybe 10 lakh rupees or 20 lakh rupees for any emergencies. That is where the ULIPs usually come in. And the ULIP being goal-oriented, the goal is protected from day one because your sum assured is protected from day one. However, the biggest benefit of a ULIP is that you don't pay the cost of that protection throughout the period. You essentially pay. Okay, so
this is an important point that that cost is removed after a certain.
That cost is only paid for the first 5-6 years because within 5-6 years.
So what you're saying is the cost to the fund to you gets eliminated or becomes less as the years go by.
See, as you look at the best ULIPs in the market, you have to understand a very simple thing. They have certain charges in the beginning, which come back to you as loyalty bonuses in the end. They are pretty much the same. Whatever is taken is essentially
kind of balanced.
So it's balanced out. Then comes the fund management charges. The good ULIPs out there are able to operate at below 1.5% fund management charge. If you look at the total cost of operation of mutual funds, it is around the 2% point. So, and the fund management charge is anyways about 90% of the charge of a ULIP. So if there is even a 0.1% charge on, so all other charges put together account for about an equivalent of about 0.1% on the fund management charge. 0.1 to 0.2%. So it's not going to be a huge difference to anybody's pocket between a ULIP and a mutual fund. One should go with which one they are really convinced about. And they will have to go and look for both of them because there will be nobody distributing any one of them because they are very low margins. So, mutual funds did away with entry loads and exit loads. And ULIPs have got very low margins for distribution, so nobody can really distribute them.
Right, Yashish, it's time for a short break. And when we come back, we're going to be talking about ULIPs and mutual funds a bit more. And also then we'll take your questions. But you can write to us at ask.policybazaar.com or you can write your queries at Twitter at policybazaar.in. We'll see you shortly after this break. Keep watching.
Show me the nitty-gritty of the big city. अगर पढ़ोगे नहीं तो इसी कार पे रह जाओगे, और अगर पढ़ लिए तो एक दिन ये कार तुम्हारी होगी।
वाह, ये कार हमारी होगी।
All new Honda City for greater drive.
Just like the morning sun, life gives us reasons to celebrate. Take the mass.
इस राह पे चलकर क्या हासिल करना चाहते हो तुम?
सिर्फ इंसानियत जुटाना चाहता हूँ। कि one man can make a difference, sir.
अब राजीव आवास योजना के अंतर्गत स्लम वासियों को मिलेगा अपना घर, अपनी जमीन पर अपना घर और मालिकाना हक।
अरे छोड़ो, ये सुनते सुनते मैं बूढ़ा हो गया।
ये देखो,
अब जिएंगे सम्मान से,
जिएंगे शान से,
राजीव आवास योजना का सहारा है।
अपना भी घर होगा, अपनी इज्जत होगी।
हाँ, शहर में ही अपना पता होगा, राजीव आवास योजना का सहारा है। शहर से जुड़े अब रहेंगे हम, रोजी रोटी और मकान का होगा ये संगम।
बच्चों की पाठशाला हो, भविष्य उनका उज्जवल हो।
राजीव आवास योजना का सहारा है। घर घर में नल होगा, पानी झरझर होगा,
आएगी रोशनी, हर तरफ उजाला होगा।
भारत सरकार, राज्य सरकार एवं स्थानीय निकायों का साझा प्रयास। राजीव आवास योजना, सबको हक।
लावा 3G स्मार्टफोन, ड्यूल को प्रोसेसर और एंड्रॉइड जेली बीन के साथ सिर्फ ₹4199 में। सपना नहीं, सचमुच।
Welcome back to Policy Bazaar. I'm Arjun Bhagat, and with me is Yashish Dhaya. And we're talking about ULIPs and we're talking about mutual funds. Yashish, you've been talking about good ULIPs. Give us an example of ideal ULIP which is really doing well, and how is it structured?
Sure. So there's one particular ULIP that's just come out about 4 or 5 days ago, and I've been talking about it for some time. It's coming out. Now, imagine you were investing 50,000 rupees into a mutual fund and into this ULIP. From today, you keep investing for the next 20 years. In the first 8 or 10 years, it will seem like this particular ULIP is giving slightly lower returns than the mutual fund. About the 8th to 10th year, it overtakes the mutual fund. In the end, by the 20th year, it actually beats the mutual fund, and it gives you a higher return than the mutual fund if they are both investing in the same asset. Typically, it takes away about 0.91% from whatever is the stock market return. So the stock market is giving you a 15% return, it will give you 14.1. If the stock market gives you an 8% return, it will give you 7.09. That's the way it operates. The mutual fund costs you a bit more. Essentially, they do it through loyalty additions. However, there are some differences. You have a 5-year lock-in, which you will not have in a mutual fund. But in a mutual fund, you may not have the discipline to keep investing for 20 years, whereas here, you will be forced to invest every year, and you will get your returns. That's how it works. According to me, a really good ULIP is now in the market, and people should come in and start taking
Investing
it on.
in that.
Start taking it on, exactly.
Right, Yashish, it's time to take viewers' questions. We've got Rohit Burman from Shillong, and he asks, are accessories and extra fittings of the car covered under the car insurance policy?
Yes, of course, they are. You've got to declare them in your electrical and non-electrical accessories. And once you've declared them as your accessories, there will be a slightly higher premium for them, for you. However, they will be covered under a comprehensive plan. They will certainly be covered. And you can also have your CNG kit, etc., covered under a similar plan. As long as you declare all of these, they are covered.
Right, Yashish. We've got Priyadarshini Roy, and she asks, and she's from New Delhi, she asks, I want to purchase a health insurance policy in my mother's name, who's suffering from diabetes. Will you advise me on the best policy for her? So, depending on her age, which we haven't got, she should either go in for, she should first try for a non-senior citizen plan. So, you know, any of the plans which does not have a co-payment. She can try a Max Bupa, a Star Health, a Religare Health, or an Apollo Munich, or an L&T Insurance. These have got good plans. Reliance Life has also brought out, Reliance General Insurance has also brought out some good plans. So she can look at these options. Typically, she can take about a 5 lakh rupee cover, which should be sufficient. Depending on her condition and the criticality of the stage of diabetes, she may or may not get a cover. There may be a certain rate up. However, in case she does not get a cover through the normal plan route, then she can go in for a senior citizen plan. Star Health has a senior citizen plan. These will usually have some co-payment of between 20 to 50%. Star, Bajaj, Max Bupa have senior citizen plans, and she can go with any one of them. With that co-payment, she will have a cover. Right, we've got Samarth Kapoor from Bhopal, and he asks, in case of pure term insurance plans, is the beneficiary of an individual, can the beneficiary of an individual have multiple term policies? And in case of an unfortunate death, will the same nominee indicated in multiple policies, will they get the benefit? What are IRDA's and government regulations in this regard? So as long as you have multiple life insurance policies and you had declared them in the last policy, you've declared the previous ones, the individual who expires in the nominee will receive the benefit of all the policies cumulatively. So every policy will pay. So technically, yes, they may have it. However, multiple policies must be taken with purpose, because an individual has a life value which depends upon their income and the number of years they're going to work for. So usually, when somebody is at 25 to 40, your life value is actually increasing. But from 40 onwards, it starts decreasing because the number of years start declining. And that is typically why you may take two policies. So a 25-year-old person having an income of, let's say, 5 lakh rupees may take a 50 lakh rupee cover. But by the time they are 40, their income may have gone up to... And usually one is supposed to make that declaration, right? One has to make a declaration. When you take the second, suppose his income now by the time he's 40 has gone to 10 lakh rupees, he can take an additional 50 lakh rupee policy and take it for a shorter period, which can go until about 50, and then he can get rid of that plan, and then he can continue with the previous plan. So it's like, you know, your life value goes up and it comes down. Right. And so in the middle, you can take an additional plan. That works perfectly fine, but you got to declare it. When you're taking the second plan, you got to declare you have a first plan. Right, we've got Ajay Agarwal, and he asks, can I take a term plan for my wife, who is a housewife? If yes, then which service or who should he take it from? So insurers like Aegon Religare, Bharti AXA, are now providing plans for the spouse. However, it is important that the primary earning member takes a plan first, and whatever sum assured the primary member has taken, the spouse, the non-working spouse, can take a cover of up to half of that. Ideally, it doesn't make a huge amount of sense, but people can do that, and these plans are available and they are selling. Thanks, Yashish. Now, that's all the time that we have on this show, but write to us at ask@policybazaar.com, or you can write your queries at Twitter at PolicyBazaar_in. We'll see you next time. Goodbye.
मुझे शक्कर से परहेज है, चाय से नहीं, इलायची वाली